Welcome to the Explainer. Today, we're going to build a complete toolkit for analyzing stocks, right from the ground up. The goal here is to cut through all the noise out there and create a really clear, step-by-step process that you can actually use.
So here's how we're going to do it. We'll follow what I call the investor's funnel. We're starting at the very top with a big picture of the economy, and then we're going to drill down step by step until we land on a final checklist that helps us make a smart call.
Okay, let's just dive right in. Look, before we can even begin to think about picking a stock, we've got to understand the world we're investing in. What's the overall economic landscape look like? It's all about setting the scene.
Now, what's so fascinating about this number is the story it tells. In 2025, despite all the economic turbulence and scary headlines, U.S. company earnings grew an incredible 16% year-to-date. And get this, that was before the Fed even started cutting interest rates, which is usually like pouring gasoline on the market fire.
And it looks like the good times are set to continue. As we peer into 2026, the experts are predicting really strong double-digit earnings growth pretty much everywhere you look. This is not just a US thing, we're talking Canada, Europe, and even emerging markets. So yeah, the stage seems pretty well set.
So, the overall market looks pretty promising. That brings us down to the next layer of our funnel. How do we find the absolute best companies inside that market? What we're really looking for are businesses that are built like fortresses. Companies that can fend off competitors for years and years.
The legendary investor Warren Buffett has the perfect name for this. He calls it an economic moat. It's that durable competitive advantage that protects a company's profits. So the big question for us is, how can we find these moats in a systematic, numbers-driven way?
An economic moat is that special sauce, right? It could be an unbeatable brand or a network that gets more powerful as it grows, or just massive scale. But instead of just going with a gut feeling, we can actually use a few key financial metrics to spot the companies that truly have one.
First up is something called Return on Invested Capital, or ROIC. Basically, it's a report card on how good a company is at turning $1 into more dollars. And as you can see from the data here, it's not even close. The companies in that top group, the ones with consistently high ROIC, have delivered much higher returns over time. It's a huge tell.
Next, we're going to look at gross margins. A company that has a consistently high gross margin has pricing power. It means they can charge more for their stuff without losing customers. And just like we saw with ROIC, the numbers tell the story. The companies with the fattest margins have outperformed the rest.
And our third clue is market share. Being the biggest fish in the pond is a massive advantage. And as this data shows, companies that dominate their industry have delivered the best returns, often with less drama and volatility along the way. That's the power of scale, right there.
So here's the real magic. While each of these factors is pretty powerful on its own, when you put them all together, whoa, that's when they become a superstar team. If you screen for companies that are top tier across all three, ROIC, gross margin, and market share, you find the absolute cream of the crop. The top group here delivered over 15% annualized returns.
Okay, let's keep moving down the funnel. Now that we've hopefully found a high-quality company, we need to give it a basic financial checkup. Like popping the hood before you buy a car.
At the very heart of this checkup is the balance sheet. And it all comes down to a super simple idea called the accounting equation. Everything a business owns, its assets, has to equal everything it owes, either to lenders or to its owners. It's a perfect balance. It has to be.
And as you're digging through those financial statements, you need to have your radar on for these big red flags. I'm talking things like shrinking profit margins, way too much debt, or cash flow that's all over the place. And oh man, if you see they keep changing their auditors, that is a huge warning sign about their transparency.
All right, we're getting close. We've found a high-quality, financially sound company. But here's the thing. A great company doesn't automatically mean it's a great investment. The price you pay is absolutely critical, and that brings us to valuation.
Now, there are a million ways to value a company, but let's just look at two of the most popular. The PE ratio. It's easy, and it gives you a quick feel for what the market is thinking. Then you have EV to EBITDA, which is a little more work, but it's much better for comparing different companies because it accounts for things like debt. They each tell you a different part of the value story.
If you ever need a reminder of why valuation matters so much, just look at the classic cautionary tale, Cisco Systems, back in the year 2000. By any measure, Cisco was an amazing, world-changing company. But that wasn't the problem.
The problem was the price people were willing to pay.
At its peak, investors were shelling out 196 times the company's annual earnings for one share. That is just insane. And even though Cisco's business grew 7 times over in the following decades, it took the stock price just as long to get back to where it started. A great company, yes, but a horrible investment at that price.
We are almost at the very bottom of our funnel. We found a great company, and we think we found it at a fair price. The last question is, when's the right moment to buy? And for that, we can turn to some basic chart analysis.
Now, you don't need to be some kind of charting wizard here. It's really just about spotting simple patterns. See a series of rising lows? That's optimism. See a series of falling highs? That's pessimism. Often, the best time to jump in is when a stock breaks out of a boring sideways pattern, and the trend flips from bad to good. What you really want to avoid is chasing a stock after it's already gone vertical. That's when it's overbought and the risk is super high.
And you've also got to be on the lookout for something called a bull trap. It's a rally that looks like the real deal, but it quickly falls apart, trapping all the eager buyers. A key giveaway is volume. If you see a big price spike, but the trading volume just fizzles out, be very, very careful. Real moves are backed by real fundamentals, not just a flash of hype.
And here we are. We finally made it to the very bottom of the funnel. This is where we take everything we've just talked about and boil it down into one final simple checklist. This is your go or no-go decision point.
So before you ever pull the trigger, run the idea through a checklist just like this. Does it pass the basic sniff test for financial health? Are its earnings actually growing? Do you, and be honest here, do you really understand what this business does and what makes it special? And finally, the most important question of all, is the price right? Are you buying it with a built-in margin of safety?
Look, this whole funnel approach, it's not about finding some magic formula. It's about creating a disciplined process. By starting with the big picture and working your way down to the nitty-gritty of a single stock, you can make more rational, more confident, and hopefully more successful decisions. You've got the toolkit now.